Hi there. In this series of videos, I'm going to be teaching some building blocks for putting deals together. And I say building blocks because these are really like, it's almost like vocabulary when you're learning a language. And it's a foundation for putting these things together later on into a framework that will help you understand how deals work and how the financing works. So if you understand these and stick with me here, I think they'll have a lot of payoff later on. And there's a couple key concepts I want to teach you in this video. Number one, net operating income, and number two, cash flow from operations. So those are the two building blocks that we'll go over. And I want you to, first of all, though, just to think about and understand that when you buy a piece of real estate, you need to think about it like a little business. So if you've ever bought stocks or been in business for yourself, each little house you have or each apartment or duplex is like a business. And like a business, it makes money. But what you're doing is you're renting space. You're selling the rent on a house. And so it has income and it has expenses, just like any other business would. And in the end, you hope you have fewer expenses and you do income and you make some profit. That's the sort of the basic concept here. And so that what these measures are going to tell you is how well that little business is doing what it's supposed to do. But secondly, the concept I want you to understand, there's a lot of ways to measure how well a business is doing. That's what all of accounting is, and it's just a big subject. It can get very unintuitive and difficult to understand sometimes, especially the more sophisticated type of accounting you talk about. And so I want to point out here that for real estate investors, this is the kind of numbers and the kind of details that we look at on the fly. You can call this back of the envelope sort of numbers. And that doesn't mean they're not accurate or right, but what we're talking about are really the essential, boiling it down to the most important parts of a deal. And what that comes down to for me on the deals I'm looking at is the cash flow. And so something you would learn as you dig into this, there's a difference between cash flow and profit sometimes, because there are all sorts of, there are some things that make a deal more profitable, like depreciation, but it might not be a difference in your cash flow. And so if that all flew over your head, don't worry about it for the moment. But what I want you to understand is that we're going to be focusing on the basics of the cash flow of a deal. So, and the reason that's important is because you can use the net cash flow on a deal to pay your bills. Your bills like the interest on a loan, the bills like your utilities, the bills like paying yourself some money. And so cash flow is really what it all comes down to. And that's the essence of a good deal, a good business, is how much cash flow it produces. So those are the two starting concepts I want you to understand. And I'm going to go over this definition here of what net operating income and what cash flow from operations are, and explain a little bit more why those are important. And so if you'll go with me here, I've got a little equation written down. And so just remember our business. What we're doing is we're going out and in the essence of any deal, whether we're buying and flipping it, if we're analyzing it as an income property, we want to look at it from this standpoint, as if we rented the house. And so in this house, we say it has some kind of scheduled rent. So if we went out and advertised it in the newspaper, what will we advertise the rent for? That's the full rent price. That's the starting point of this whole equation. But right off the bat, we have to recognize that at some point, even if it's a great property, at some point, maybe 3 years later, the property is going to be vacant. And so that's not an expense, so to speak, right off the bat, like we're paying some of these other expenses, but it is something we have to account for, because if we had a scheduled rent of $1,000 and it was vacant 1 month, we really have lost $1,000. And so we need to have some kind of accounting for that, and we call that a vacancy reserve. And this can vary a lot, but when we look at some examples later on, some case studies, you'll see what some typical vacancies are. But just for now, know that you'll take out some kind of percentage from the gross rent, and then you'll end up having a gross rent that's adjusted for vacancy. So it's called the gross adjusted rent. And so that's the point then that we start taking out the rest of the expenses here in red. So we have things like maintenance. Maintenance are your everyday type of expense items that with the property. So the faucet might start leaking, and you have to call a plumber to come out and change out the faucet, or the toilet's leaking. Or even in my maintenance category, I put if it's a duplex complex of apartments or duplexes and I have to pay for the lawn, that's lawn maintenance. So all those would fall into that category. And these are just your everyday type things. And people underestimate this very often. So you want to make sure you know what kind of maintenance your property will have. And not all properties are created equal. Though some of your best rental properties have lower maintenance items, so they don't have to be painted as often. Maybe they're brick and have vinyl siding on the soffits and next to the roof lines, and so that would be a low maintenance building, as opposed to a building that has a lot of wood, has a lot of potential for things that sharp edges, things that can break easily. That would be a high maintenance building. So that can vary depending on your building, but that's definitely a cost you need to take out of your gross rent as you're operating your business. A second item is a management fee. So it might be that, I teach a lot of people who are kind of mom and pop kind of landlords, but even so, you need to build in, if you're doing it yourself, some kind of fee for yourself. Because if you ever decide not to manage these properties, which would be nice eventually, right, to travel or do some different things, you need to be able to pay someone else to do it. And it's nice to have that discipline of when you're doing it yourself, you need to pay just like you would anybody else yourself, so that you have some money to spend even on this rental property. So a management fee, that might be a number like 10% of the rents. So if it was $1,000 and you took out let's say a $50 vacancy reserve, then you would have $950 left over, and then you would have so 10% of that would be maybe $95 would be the amount of management fee that you have. So that's one of your expenses. You probably know about property taxes and landlord insurance. This is not income taxes, these are property taxes that your local municipalities would require you to pay. So that pays for schools and 911 and fire safety and that sort of thing. And so that's just a fee that you have to pay on a yearly basis. And it's important to set that money aside every year on your rental property, every month, so that you have it at the end of the year. And the same with insurance. It's typically paid on a yearly basis. And that will cover things like fire, wind, hail, and then also, importantly, liability insurance. And you have some kind of amount of liability insurance. So it's usually hazard and plus liability. So those are those expenses. And then finally, there's sort of a miscellaneous category. Not every property will have these, but if you own a multi-unit building, you might pay the water, or a mobile home park, you might pay the water for some of those. That's less than ideal, but it might be the case, so you want to make sure you account for that. Some properties have an HOA. I have some rental properties that have a local city license. In order to rent a property, you have to get a license, and you'd want to account for that. In my case, it's $100 a year, so you'd want to figure that out in your analysis. And this is all usually done up front, remember, when you're analyzing your deal to see if it's a good deal or not, or to see what you want to pay for the property. This is what you're doing. And when you subtract all of those expenses from your gross adjusted income, you get one of the numbers that we had wanted to talk about from the beginning, the net operating income. And I tell people I'm working with that this is one of the most important numbers in all of real estate, the net operating income. And it has a close relative here, and this is the video I wanted to explain what the difference between these two are. There's net operating income, and then another one called cash flow from operations. And I have actually called net operating income in the past. What I called net operating income was actually, what I meant by that was cash flow from operations, because there's one other item we need to account for. When you hold a rental property for a long period of time, let's say you held it for 15 years. Think about the other kinds of things that might go wrong other than just these expenses that we have here. You have a heating and air unit. Is it possible that the life of a heating and air unit will go out within 15 years? Absolutely. And if that, today when I'm doing this, if that's a $3,500 item, then that is another reserve, like the vacancy reserve, that you need to be setting aside. And so there are things on your property that are wearing down and are going to go out. And the big ones, the big expenses are HVAC, roof, hot water heater. There might be some other systems I'm not thinking of. But if you total all those up, it's smart to allocate some of those expenses and set that money aside. And this is something that not many people do. More the professional investors do, but a lot of the mom and pop investors, we forget this kind of number, and we go along like things are rosy and great for 10 years, and then all of a sudden your property starts wearing down, and you don't replace things well, and you try to get cheap because in the very beginning you didn't allocate that expense, that reserve. And so I recommend it. And when I look at numbers that other people have done, I realize they are typically underselling the actual cost of their property. It's very common to do that. But if you want, when you're buying it, you want to make sure you understand exactly what you're getting into. And so really the most important number I think here is this cash flow from operations, because you want to account for all the expenses. And so these, for many people, when you're talking to them, they might say net operating income and mean cash flow from operations, where they've taken all the reserves out. But I think it's important to know the difference between the two and know the concept. The most important thing is the concept is you've got a certain amount of income, you deduct all of your negative cash flow items, and you come up with some number here at the bottom. And this is the net cash number that you can use to pay all of your bills. So you can use it to borrow money, which is one of our main topics here. You can use it to pay back a lender. You can use it to pay yourself a return on any money you've put into the property. So that's the key building block here. Is we're going to use this figure and this calculation over and over and over again for some other important ways to analyze deals. So I hope this sinks in for you. Go back and watch the video if you want to go through, understand these numbers a little bit more. And we'll go through a lot of examples on how to use this and what to do with these figures later on in some other videos. So I'll see you soon.